It gives me great pleasure to bring on board Mr. Ashok Tyagi of DLF to talk about how he is expecting the impact of second wave to impact A, residential sales, B, footfalls, and C, where exactly are real estate prices headed now that inflation has made a comeback. Mr. Tyagi, fantastic to have you back on ET Now. Thank you for joining us. I'm going to ask you the obvious question, which you knew that I would have asked you, which is that what has been the impact of the second wave on residential pricing and demand? When we spoke to you before that, you did say that there was a uptick which had come in demand. Prices were stable, but demand had made a comeback. What's the update now?
Okay, so good morning, Nikunj. So clearly, when we spoke last, we were coming off the first wave, and frankly, from October last year onwards, there was honestly a very strong bounce back of the entire residential segment. We ourselves did a number of new launches as well in the low to mid-rise category. The super luxury product started moving very well. In fact, even the mid-income housing was moving very well. And I think that trend sort of sustained through Q4 till March, as our results show as well. Not only ours, most listed company results would show. Clearly the sort of the break to that entire journey happened with the second wave, because for almost 6 weeks, everybody was in a variety of lockdowns depending on the geographies that you were. In NCR, both Delhi and Gurgaon and Noida, all the major geographies were closed for almost 6 weeks. But since things have begun moving back, I'd say from the second half of May onwards, I'd say the residential sales seem to have come back. I wouldn't say that, it's been a completely smooth, bounce back as if those 6 weeks never happened. But again, the bounce back is looking strong. The sales, we had a lot of sales discussions which were interrupted by the lockdown. Those have resumed and those sales are beginning to get consummated. We are reverting to our launch pipeline as we had indicated. So hopefully, this was a 6-week interruption, unfortunate. But I think on the residential side, things seem to be coming back into the stride as they were.
So can I safely assume that you would not like to change your target for FY22, which is of 30% growth and sales booking guidance of 1,000 crore per quarter?
So I think directionally, we stick to the 1,000 crores a quarter guidance, Nikunj. But in all fairness, there could be a quarter like the one where we are currently in, where because of the long inactivity period of almost half the quarter, that guidance could be coming off slightly. But directionally, I think 1,000 crores a quarter, our launch pipeline, our existing inventory supports that sales guidance for sure.
I distinctly remember, Mr. Tyagi, that when the first wave happened, we spoke about the concessions you had given to your tenants, and especially some of the tenants which were occupying shops and stores in the mall. Are you considering something like this right now also? And if yes, could you share more details with us?
So in all fairness, Nikunj, this is the remit of the entire rental business is a JV with GIC. So I'm sure those discussions are going on, but I don't necessarily have a decision which I can currently announce. But clearly, we continue to be very sensitive to not only our retailers or office goers. We have enhanced the levels of safety, the levels of filtration in air conditioning, all of those things. And clearly, we would be trying to help all the concerned stakeholders. But a specific decision that we are asking, honestly hasn't been taken yet.
Okay. Given that buyers are currently enjoying lower rates, Mr. Tyagi, and that they're unlikely to be hiked soon as well, can we expect buying interest to remain? What's the kind of momentum that you're looking at? And can real estate now be considered affordable? Are we looking at that in mid and lower income housing?
So clearly, the low or the more moderate interest rates of the sub 7% for home buyers has been a huge driver to this entire resurgence of the demand in the residential segment. I don't think there can be any two opinions on that. Luckily, you are right that despite the inflationary trends and all, the home mortgage rates continue to be in the sub-7 range, which makes the EMIs far more affordable. And when I say affordable, honestly, it's affordable across price segments. So it's affordable for somebody who is borrowing for a 50 lakh loan, and it's affordable for somebody who is borrowing for a 5 crore loan. So I think clearly this the benign climate of home loan rates, frankly, I think continues to be a very strong driver. And I think has been one of the factors which has been behind this entire, growth or the bounce back in the residential segment in the last 6 to 8 months.
Okay, so you talked about inflation. Is there any scope to actually pass on those input costs as well? And secondly, what are some of the other triggers that you feel can play out? I mean, clearly this is a trend. You've described it when it comes to affordable, when it comes to demand being robust there. But what are some of the other trends that could possibly play out in this particular segment?
So look, I think clearly one thing that the so-called downturn in the last 3 or 4 years has taught not only us, but across all players, is that nobody should be, if I may use the word, flamboyant or cowboyish as far as pricing strategies are concerned. Having said that, the demand for the right product at the right location with the right credible builder, I think is clearly seeing a significant strengthening. So as an example, we launched our independent floors, which was like a four-storied, offering in Gurgaon in October. And in the last 6 months, I mean, the difference between our first launch and the pricing at which we are offering today, there's almost been a 30% plus increase, fueled by the demand, frankly. And the product is still being absorbed. So clearly, I think if you have the right product, I think there is pricing opportunities. But people should not, just price themselves because they believe that a product cannot be dipped below a certain price. I think you have to price it what the market believes is the right price for that location. And I don't think, that you can price it unrealistically now. But clearly, as our independent flows show, there is definite scope for price improvement as the product sort of gains acceptance in the market.
Sure. Mr. Tyagi, what about commercial spaces? How are the occupancy trends there? And does work from home continue to be a big threat?
So look, let's first look at the data. Our vacancy levels used to be in the 4 to 5% range for a very long time. And as our reported results for March and quarter show, our vacancy levels are currently running at 11 to 12%. And we don't rule out the fact that the vacancy levels in offices could go up by further a couple of percentage points. In fact, that's also fairly consistent with the results that the listed REITs are also showing. So clearly, the vacancy levels have sort of gone up. It's driven by 2 or 3 things. One, not just the strategic shift from work from home, which we believe is a temporary thing. And while work from home will be a very strong component of work going forward, I think clearly it's not that people will not begin coming back to offices. And to some degree, at least, the work from home impact will be neutralized by hopefully greater de-densification in offices. Those classical norms of 70 to 80 square feet per workstation, I think those would need to be enhanced given the entire COVID situation, and the planning go forward. But definitely in the last couple of quarters, and I think clearly the second wave has not helped, there is a tendency of the new lessees to defer decisions. Site visits, unfortunately, are not happening. Many times for most multinational, tenants, their APAC teams or their global teams used to do site inspections. Those visits obviously haven't happened. So those have also deferred the entire discussion on new leasing. So clearly, the vacancy levels, I think, will continue to be to be at these levels possibly in the next couple of quarters. But again, fundamentally, the India story hasn't changed. The ITES, research, BFSI, all of those sectors continue to be strong. The premium on Indian talent, I think, will continue to be there, if not strengthen even further. So we still believe that, yes, will this cost us, 2 or 3 quarters in the entire process? For sure, yes. But I think fundamentally the trajectory should come back. In fact, we are continuing with the capex of building out, 3 of our major capex projects, 2 in Gurgaon and 1 in Chennai. During the intense period of the pandemic, we signed a big deal in Chennai with one of the biggest, foreign banks, which is their single biggest facility across the world. So things are happening, but yes, clearly there is a slowness of decision making. There is a hesitancy in signing up large spaces, and we believe that this could be in the next 2 to 3 quarters. It could take before things sort of start coming back to normal.
Okay, fair point. Thanks for giving such detailed insight on, prospects for the commercial real estate space. The other thing I wanted to talk about, Mr. Tyagi, was also the overall debt picture at DLF. Because you've also indicated the progress on getting the DCC, DL REIT, which, as I understand, is ready and remains on track. Give us more details in terms of the assets which have been identified and the timeline for the REIT.
Okay. So again, what we are saying is that the entire DLF Cybercity portfolio, which is the joint venture with GIC of Singapore, so that entire portfolio has a run rate, hopefully in the about 3,700 odd crores per year of rental income. And we are in the process of doing the internal structuring steps that will be required to make it REIT ready. Obviously, again, the entire lockdown and the stop-start nature of life in the last 6 months has led to a delay of maybe a quarter or so. But I think we are broadly on track to have it the internal structuring steps completed for us to be REIT ready in the next 4 quarters. Now, when the REIT actually happens, I think is a combination of really 2 things. One is obviously how the macro markets are in terms of interest rates, the performance of the other listed REITs, the overall interest of FIIs and domestic institutions in the REIT as a product. And B, frankly, a decision of when the 2 shareholders, GIC and us, sort of jointly take of when we are sort of looking at actually approaching the markets. But we clearly want to be in a situation where we are completely ready, but for like the push of a button, if I may sort of say. And then we wait for an opportune climate and an opportune decision by the 2 shareholders to move. So right now we are getting REIT ready. We are not necessarily moving into a REIT public listing immediately, but we are definitely getting ourselves ready for a REIT.
Mr. Tyagi, DLF is been very cautious. You've reduced debt. You were criticized for having a very high debt, and now you've reduced debt. The same folks who criticized you for taking risk 10 years ago are now saying is DLF very conservative. When everybody is committing to capex and expanding their balance sheet, is DLF likely to miss out now that a new capex cycle has started, a new revival cycle has started?
So, Nikunj, you've been a veteran in these markets. So, I think clearly there was a like what should I say, a joyride that all of us took in the 2007 to 2009 timeframe, which frankly I don't think we are necessarily prepared to go down that path again, even as we see some of our compatriots, embark on those journeys. But conservatism is a relative term. Frankly, we had a significant amount of WIP inventory, etc., which we were intent upon completing and getting to the customers despite the markets being what they were in the last 3 or 4 years. And I think we have now completed that entire cycle. So clearly, as we have indicated in the last 2 quarters, we are now, embarking on the next build-out cycle, definitely. In fact, that's the reason we are beginning to get these newer launches into the market as well. And so far, you have seen them in Gurgaon. I think over the next quarters, you will start seeing them in Delhi. You'll start seeing them in in other parts of geography, including South. And I think so you will clearly begin so what should I say, far less coy in terms of getting the products that we have into the market in terms of new launches. Now, in terms of buying new assets and that sort of a thing, frankly, we are not, crazy about buying stuff. But if there is an interesting or a tempting opportunity that arises in a micro market where either we do not have a presence and we want to have a presence, or, something which sort of strengthens our existing portfolio or existing land bank, sure, we'll be open to it. But clearly, yes, we are not hungry for growth through acquisition because, frankly, we have enough land pipeline at our end to be able to, sort of deliver a sustained growth on a, on a reasonably consistent basis go forward. In the rental business, as I mentioned earlier, we are already, working now on 3 new build-outs, 2 in Gurgaon and 1 in Chennai. There should be 1 more in Hyderabad coming up maybe in the next few months. And I think clearly we remain committed to the fact that despite the short-term blip that's happened on the offices market, I think fundamentally in the next couple of years, by which time these capexes are ready for leasing and for operations, hopefully the demand cycle should have begun coming back.
You are generating a lot of free cash flow, and that's evident in your last quarter number. You don't have any large investment plans. That's what I can understand based on your answers. So what will you do with the existing cash flow? Is the plan to make DLF completely debt-free? Because real estate companies in India, like a Godrej or even Oberoi, they do have debt-free. They are debt-free, and they do get a premium because of that.
Okay. So, yes, you're right. Someone like Oberoi is debt-free. That is correct. So, I mean, in all fairness, Nikunj, at a debt of about 4,900 crores, I mean, we are at debt equity, I think, of about 0.15:1. So, I mean, we clearly do want our debt to come down further. But I think debt as a cause of sleeplessness, I think that chapter is over, frankly, for us, and hopefully also for our investors, because, at these debt levels, I don't think, anybody should necessarily be worried about the debt overhang. Our net interest cost on a quarterly basis now down to about 150 odd crores a quarter, 150, 160 crores a quarter. So yes, we would clearly want that number to keep on coming down, want our debt to start to keep on paring down as much as we can. But we are no longer going to take, dramatic big ticket decisions to reduce debt, in terms of either big ticket disposals or anything of that sort. Debt will come down operationally now. That is clear. So the more we launch, the more we operate, the debt will come down basis that. It will not come down through non-strategic actions or through non-core disposals and that sort of a thing. But yes, I mean, clearly, that is something that you ideally want to keep it as low as possible, and that will happen. And on the Rentco side, I think our debt to rental ratio is about running at 5.5 years of annual rental, which again, I think over time, including, with the prospect of a REIT, is again something that should slide southwards. So I think on both of these sides, I think we are pretty comfortable, but we will continue making efforts to get these further into control.
Okay, so I'm going to summarize today's interaction with one very straightforward question. A bit of a history here. I've had the privilege of tracking DLF for more than 20 years now, even when it was not listed. Between 2000 and 2010, DLF was in an expansion spree. They expanded. You went public. You raised a lot of debt. Then between 2010 and let's say 1920, you started contracting. You reduced a lot of debt. You sold a lot of non-core assets. Next 5-7 years, what is DLF? I mean, what would be the shape of DLF? Steady, but low risk?
So, I mean, clearly we would be looking to grow again. That is very clear. But grow again with a very acceptable and a moderate level of risk. Luckily, the one thing that 2000 to 2010 period gave us was an enormity of the land bank that we have. And clearly, I mean, a lot of those land banks had not been monetized in terms of productively monetized. And that's the cycle that we are beginning, both in Gurgaon and in the other geographies. I mean, in central Delhi, our residential JE with GIC Nikunj has a potential of 8 million square feet of prime residential housing in the heart of Delhi, which again is something that we are commencing within this fiscal. So clearly, I think we will be back on a growth path, but our growth path will not be, I mean, we are not in a treadmill with anybody else. And, in all fairness, if somebody wants to sort of claim that we are the largest builder by residential sales, we have no quarrel with that. We don't want to be in that space. I think we clearly want to be the highest and the best EBITDA performer in the markets. We clearly want to be the most sustainable growth player in the market. And hopefully, we clearly want to be the player which has the sort of the perfect balance of a residential business and a commercial business, which is what we've been trying to strive for all these last years. And I think clearly, I mean, the gear of the performance will definitely go up, but we'll ensure that, all the risk, compliance, and everything else that goes with it, all of those, matrices are completely taken care of as well.
All right, Mr. Tyagi, great to chat with you today. A nice in-depth
Thank you.
conversation on everything that's going on at DLF as well as with the industry. Thanks for joining us.